Thank you for attending our Security Health Plan Life Focus webinar exclusively for our Life Focus employer group. My name is Angie Pirro, and I'm a health educator with Security Health Plan's Life Focus program. Before we get started, it's important to mention that the information provided today is designed for educational purposes only. It is not a substitute for personal financial counseling or planning. Please consult with your financial consultant regarding any questions or concerns regarding your financial wellness. A few housekeeping items to begin with. Remember to have your speaker's volume on your computer turned up, and to ask any questions, please use the questions tab on the control panel. We also encourage you to monitor and use the chat feature where we will discuss today's webinar topic. The webinar will be recorded and archived for later viewing, so we encourage you to share this broadly with your employees and coworkers. And shortly following the webinar, you will have the opportunity to provide us with feedback on today's webinar. We encourage you to take a few moments to complete this evaluation. Also, it's important to note that if you are participating today as part of a workplace wellness incentive program, please keep in mind that if you are viewing this presentation as a group, you will need to contact your wellness representative to learn more about how to confirm your attendance. Today's webinar is entitled Retirement Income, The Landscape Has Changed. And we are very excited to have with us today Roy Kaiser. Roy has been elected, or was elected by the Marshall Clinic Physician shareholders to serve 3 terms on the Marshall Clinic Retirement Plans Board of Trustees for a total of 8 years. In August of 2008, Roy accepted a full-time role with the Marshall Clinic Retirement Plans as a Senior Financial Analyst Planner. In this role, he helps to manage over $2 billion in retirement assets and assist individuals with their investment management and retirement planning. Roy holds a Master's in Business Administration, and he is also a Certified Financial Planner Professional, a Chartered Financial Consultant, a Qualified Plan Financial Consultant, and also holds a lifetime designation as a Certified Purchasing Manager. So that was quite the mouthful, Roy. And I always wondered what all those letters meant, but holy moly, that sure does give way to your areas of expertise and the level of knowledge that you do carry with you. So I'm really excited to introduce you to everybody today. And without further ado, I will hand it over to Roy so that we can learn a little bit more about this landscape that is ever-changing. Thanks for being here today, Roy.
Thank you, Angie. So I want to start with just kind of summarizing a couple of objectives that that I'd hope to help you understand today. And it's primarily about retirement income sources and how those sources have changed and have actually changed pretty dramatically over a fairly short time period. So I use this term, the 3-legged stool. In some of the financial service publications, you'll see the 4-legged stool because tax-deferred retirement savings and after-tax savings are broken out into separate categories, but 3-legged stool is fine. And essentially, it's the 3 main sources of retirement income, first being Social Security, the second being pensions, and more specifically, guaranteed pensions. Pensions that pay a guaranteed income in retirement, and then finally retirement savings. And retirement savings in today's environment generally means some type of tax-deferred retirement plan provided by an employer or provided through an individual retirement account. The key issue that I want to focus on is the shift that has occurred. And there's been a dramatic, a very significant shift that have caught many, especially the early baby boomers, off guard, and that is the fact that retirement savings needs to provide much more in retirement income than it has in the past. So it's become the key leg in today's world. And so then I would like to provide at the end a couple of key factors to success as to how future retirees can build adequate income in spite of the change of landscape. So first, let me talk about past generations and just kind of point out a couple of things as to why it was different for them. On the top of the slide here, I have a note about adequate retirement income. There is this kind of rule of thumb in financial planning that we all should seek to have retirement income assets that can produce 80% of our working income. Now, those that are more conservative will say, well, it should be 100%. But many times I have individuals or couples who come back to me who are at the very final stages of planning for their retirement, and they'll say, you know, we don't really need 80%. We've looked at the detail, and 60 or 70% of our working income will be adequate. And that's great, but just as a rule of thumb and as a target to plan savings around, this 80% rule is, I think, a good rule to follow. So past generations, on average, not everyone, but on average, an individual would receive 30 to 50% of their working income from Social Security. Pensions, many had pensions, not all, but many, and these guaranteed pensions often kind of doubled that amount, or 30 to 40%. And so their retirement savings, if it was 10 to 20%, that generally meant that they had enough to live a comfortable retirement, because, you know, if you add up or even just use the average of all three categories, you'll see that you know, they would have 80% of their working income. And so that generally allows for a comfortable retirement. But now, what about today? What has changed? Well, the 80% rule hasn't really changed. I think it's still relevant and a good target for most of us. But Social Security has been decreased already, and I'll talk about that a little bit more on the next slide. Social Security, the trust fund. The trust fund is going to have to support more retirees, so the Social Security Administration has already made an adjustment by extending the full retirement age under Social Security, and I'll explain shortly why that's reduced the benefits some. And then there's pensions, and I show on the slide here 0% for many. Many, especially younger workers now, do not have a guaranteed pension from an employer or other organization. Governments, many government organizations still tend to have pensions, and that's good, but in the private sector they've essentially gone away, and there's been this dramatic shift to retirement savings plans like 401k, 403b, 457, other types of tax-deferred retirement savings plans. And so obviously, if the pensions are not there to support retirement income, then something's going to have to make up the difference. Social Security is not going to do it, and so we all essentially have to do it by saving more for retirement. And so retirement savings producing 50% or more of our retirement income is necessary currently and in the future for many workers. Okay, so a little bit more detail about what has changed. I've already mentioned that Social Security has extended the full retirement age. Those born 1960 or later you now have a full retirement age of 67. Under the current law, all individuals are still entitled to have a right to apply for Social Security at 62, but by pushing out the full retirement age, those that claim early get more of a reduction if they claim early. So that kind of is the first baby step towards reducing the Social Security benefit. And there's future reductions coming. Currently, under the current projections, the surplus in the Social Security fund, and I like to point out that it's the surplus, not the Social Security fund entirely, but the surplus in the Social Security fund is projected to run out in the year 2033. If nothing changes at that point, what Social Security has promised, only about 75% can be paid to future retirees. So there's going to be more reductions in Social Security. And as I mentioned, traditional pensions have primarily gone away, other than for government organizations, but even government organizations are starting to follow the path of the private sector by by doing a couple of things. One, providing a savings plan for their employees in many cases, or opening hybrid plans. The state of Wisconsin is one example of a hybrid pension plan where the amount contributed is both the state, the taxpayer, as well as the individual. So hybrid plans are becoming more important. What has replaced traditional pensions? Well, defined contribution plans. And I've listed 3 here: 401ks, 403bs, IRAs. There are a few others. And I'm going to differentiate on the next slide here the key difference between the these two types of plans: traditional pensions and defined contribution plans. So a defined benefit plan, or the traditional pension plan, very much a different program. First of all, a retirement benefit is generally defined by a formula. And as an example, a company may say, well, for every year you worked, we're going to take a look at your average salary of the top 5 years, and for every year you worked, we're going to pay you 1% of that average salary, up to a maximum of 40% of your current salary. So going back to a previous slide, someone may have a defined benefit plan that pays 30 to 40% of their working income. And here's another key issue and a key difference is it's guaranteed per se, because the investment risk remains with the organization. The organization has to invest the money collectively to ensure that it can meet its pension liabilities. And in many cases, it's the taxpayer who guarantees that guaranteed payment. Now, compare that with the new types of plans, defined contribution plans. And just as the term indicates, what is going into the plan is defined, not what is being paid out in retirement like a defined benefit plan, but what is going in is being defined. What's going to be available in retirement is going to be based on a number of variables. One, how much an employee contributes, how much the employer continues to contribute, or in many cases when in difficult economic times, the corporations especially will stop the contribution and then restart it later. And then, of course, the market returns. As all of you probably know, market returns are not predictable. We have averages that we can use, but markets tend to be volatile and unpredictable. So with these defined contribution plans, in many cases, you'll have a formula that defines what goes into a plan, and I've just given one example here. A company may have a 50% match on up to 6% contributed by an employee. And again, the key issue here, key difference between a DC or defined contribution plan versus a traditional pension is that the investment risk is with the individual. The organization does not invest the money. It's really up to each individual to decide how to invest the money. So with the new environment, there are a couple of key challenges with educating and preparing the current workforce for an eventual retirement. And I've listed a couple of them here that come to light in my daily job. And first of all, many don't understand how much Social Security actually provides. When you think about it, go back to those of you that are maybe a little older, go back to when you were in your 20s, 30s, and 40s. Did you ever really stop to think about, well, what is my Social Security payment going to be 20, 30, 40 years from now? No, not really. So the fact that the Social Security benefit is quite limited, it comes as a surprise to many people. I have the average benefit in 2012 listed here on the slide. It's just under $15,000 a year. Those of you that are interested in investigating your Social Security estimate, and I realize if you're quite young, the estimate is not real valuable, but those that are under 60 years of age now must go online to the Social Security website, and you can get an estimate of your eventual Social Security benefit. Those that are 60 years and older should be receiving a paper report in the mail, provided you're not collecting Social Security. Social Security Administration sends a paper statement for those 60 and over. Second, I think major factor in this new environment is there are many employees, or at least some employees, who really are not aware of traditional pensions. or the removal of traditional pensions. I probably receive 20 calls a year from Marshfield Clinic employees who have decided to retire, are within a year of retirement, and they ask me to estimate or project what their pension is going to be. They don't know that they don't have a traditional pension, so I have to explain to them that what they have is a defined contribution plan. And I can provide them an estimate of what their account balance will likely produce, but it's not a guarantee. It's not a pension. It's not something that they can count on. So in thinking about defined contribution plans and the fact that these account balances build over time, another challenge is even if they understand, even when we understand the fact that we have a defined contribution plan and we have the investment risk and there are no guarantees, most or many don't understand how much a defined contribution can produce in retirement income. And when I say retirement income, I mean sustainable retirement income. That means, and I'm showing this 4% rule of thumb on the screen here, there is this 4% rule of thumb. Some would argue that it should be a little bit less in today's world. But you take a typical account balance in a 401k, and at retirement you hopefully can draw out about 4% a year and have the account be there for 30 years or hopefully longer. In other words, self-sustaining through investment returns. So it's very easy to look at a big number, $500,000 a year. Wow. But what does that produce in retirement income? Well, under the 4% rule, about $20,000 a year in retirement income. That comes as a surprise to many people. And then there's human nature. Retirement for many, especially younger workers, is decades away concern. Is a decades away concern, and I like to use the analogy of health management. Most of us probably knew in our 20s and 30s that we should exercise regularly, but hey, you know, any type of health concerns seem to be decades away. Same kind of problem with retirement and the fact that it's decades away. But saving early and often is one of the most effective ways to ensure that one will have adequate retirement income. And I mentioned here that compounding returns are magical, and it's in many cases, for those that have been in the workforce for, I'm going to say, 10 years or more, many times the investment returns that they're receiving are more than their annual contributions. In any average or typical year where we have average market returns, that is the case. And so, you know, as an example here, I show a 35-year-old who has $200,000 saved, receives an 8% return, which was about an average expectation, and receives also a 5% contribution from their employer. If they're paid $50,000 a year, they're going to have an $18,500 increase in their account in that year. A similar 35-year-old, but with $20,000 saved, is only going to have about a $4,100 increase in a year. And now I know this year, 2013, has been a wonderful year in the markets, especially the U.S. stock markets, but I took a sample snapshot of this typical individual this morning in the Marshfield plans. And individual number one there, the one with $200,000 saved, within the Marshfield plans as of today would have about a $30,000 increase in their 401k account. Individual number two with $20,000 saved would have about a $5,000 increase. So again, saving early and often and the magic of compounding returns are very, very helpful when it comes to saving for retirement. They're also, even though the environment, I think it's fair to say, it's much more difficult to save for retirement because more and more has to come out of our paychecks, but the fact is the government and employers are providing some nice incentives. Many times these incentives are not maximized or capitalized upon by employees. Matching contributions, in spite of it being free money, you might say, there are a fair amount of employees who don't participate and therefore don't collect a matching contribution. The government allows, I'm going to say, reasonable tax deferral limits so that we have plenty of room, most of us, to save adequate adequately for retirement. I have the two maximums on the screen here, $17,500 if you're under 50, or for those 50 and over, it would be $23,000 this year. So generally, plenty of opportunity to save in these tax-deferred accounts. Another major problem is account balances are not rolled over when we change employers. You know, it is a mobile society. On average, an individual will work for 7 or even more employers in today's world, and when they make that change, they do have the option to cash out a retirement account, and too many of them cash it out rather than rolling it over and keeping it in a tax-deferred environment. And then also individuals don't actively or proactively direct how their investments should be made. All plans actually will have something called a qualified default investment alternative. Basically just means your money is going to be invested somehow in a reasonable way until you direct how you want the account invested. But a fair amount of employees don't take the time to specifically point their investments in a direction based on their age or retirement timeline. And then a couple of other additional benefits that employers provide or the government provides that are not maximized by enough individuals. One is Section 125 plans. Section 125 simply means these are the type of plans where, for example, you can save tax-deferred money or gross income to pay for qualified medical expenses. Many individuals don't take advantage of a plan like that. I also list advisory services. For example, my position or other similar type positions are provided by employers where you can get help to work these programs that have become more self-help, and many individuals don't take advantage of the services. Okay, so to kind of finalize here, a couple of keys to success for today's workforce. Well, some of these I've already talked about, and just to kind of summarize, you really have to understand what the new retirement reality is. Social Security is going to provide limited income, probably less than even your estimate that you're currently getting from the Social Security Administration. Most are probably not going to have guaranteed income or a guaranteed pension. So the majority of our income is going to have to come from retirement savings. And so one of the things that you want to do, and advisors can help you do this, is calculate a rough estimate of the savings that you're going to need now on this third leg of the retirement income stool. You know, the money that you're putting away in a tax-deferred plan. And I've already mentioned it many times, the advantage of saving early and often. Key, just so key to having adequate retirement income. Another rule of thumb is that throughout a working career, we should all attempt to save 10 to 15% of our income in a tax employer-based or individual retirement account of some type. Take advantage of those compounding returns and take advantage of government and employer-provided programs. And very importantly, know that retirement accounts are for retirement. I know that it's nice that you can take a 401k loan in many cases, depending on your plan. I know that the option of withdrawing money when you change employers is available, but all of that works towards not having enough in retirement income. Retirement accounts are for retirement, and just as with many things in life, retirement will be here sooner than you realize. So with that, I'm going to turn it back to Angie. Thank you for your time today.
Thank you, Roy. That was a lot of really good information, a lot of food for thought. I think that a lot of viewers today are going to go home thinking a little bit more about their retirement. I know I am. And so I think with that, we're going to open it up to some questions from the audience. So if you do have any questions, please use the chat box feature on your dashboard on that screen there. You can just go ahead and enter in your question, and we will present those to Roy. We do have a couple that have come in, and the first question is regarding Roth IRAs and the traditional IRA. Which is better?
Okay, so there really aren't any clear-cut answers on whether paying taxes now versus avoiding taxes now is better, and it's going to depend on the individual saver. There are a couple of, I think, fairly clear-cut examples where it makes sense to use Roth, pay taxes now, versus tax deferring the income. So first of all, young individuals who are just entering the workforce and most likely are in the lowest tax bracket they're going to be, now would be a good time to use the Roth, pay the taxes when you're in a lower tax bracket, and then as you get to the mid and senior point of your career when you're in a much higher tax bracket, maybe shift to tax deferral, because once you go into retirement, most of us can generally reduce our income in retirement. As an example, until we're 70 and a half, we don't have to take any money out of 401k plans, and so we can reduce our income in retirement, and so that would favor tax deferral, paying taxes at a lower rate, waiting. The second example, I mentioned one, younger workers. The second example that I think is fairly clear-cut to me are those, I'm going to say a few years, maybe 5 years from retirement, and they know for certain that their income is going to go up in retirement. In other words, they're going to actually have more in taxable income in retirement than while working. Well, for them it makes a lot of sense to maximize the use of the Roth. Again, pay the taxes now when they're in a lower tax bracket, and then avoid taxes, tax-exempt income, when they would otherwise pay higher taxes.
Thank you, Roy. Another question is, are there simple resources to learn how to invest wisely for retirement, whether on the web or some kind of handle somewhere or a place to go?
Okay, so I would say custom building a retirement program is probably not a simple process. However, there have been a number of products that the industry has come up with to make the process simple, and so I'm just going to mention one. You might hear them referred to as target date funds, or life cycle funds. For example, our plan record keeper of Fidelity Investments, they refer to their target date funds as freedom funds. Basically, all you really have to do with freedom funds or target date funds is estimate your retirement date and put all of your funds into the appropriate retirement target date fund. So for example, if I wanted to retire 5 years from now, I would invest all of my money in a target date 2020 fund, and because it's a 2020 fund, the amount of stocks, the amount of money in stocks, the amount of money in bonds is going to be adjusted by the investment manager. So it's very much an autopilot program and very popular. Within the Marshfield Clinic retirement plans, we don't have target date funds, but we do have a number of options that, again, are autopilot-like that can keep the process simple. So it's not a simple process building it from the ground up, but the industry realizes that, and they have come up with products to help keep it simple.
Thank you. One last question we have here today. Are you aware of any government intervention with 401k plans that may take place in the future?
So there aren't any real, there are a number of proposals out there that would allow the government to have more tax revenue sooner rather than later. I'm not aware of any that are real, that are seriously being considered at this point. One that is probably the most serious, although again it's really not gotten a lot of traction, is something called a 2020 rule, which would cap the amount that we could save in tax-deferred plans at either $20,000 or 20% of our income, whichever is less. And so for many people that would result in they couldn't save as much as they can under the current rules. So I think it's kind of wait and see. The government is going to continue to look for sources of additional revenue now, given our national deficit. But there's nothing, there's nothing at the doorstep at this point.
Thank you. Some great questions. Thank you everyone for participating today, and especially a huge thank you to you, Roy, for being here today. We are very excited to have you because wellness encompasses so many different things, but financial wellness is an area that I think all too often gets kind of shoved to the side, and we need to bring back to the forefront when we talk about wellness. So thank you for shedding some light on that, and I think the information you share is also very applicable to anyone, no matter where they are in today's workforce. So we'd encourage you to, as an audience member, to do some thinking about everything that Roy said today and really investigate your own personal financial wellness. So again, a huge thank you to you, Roy, and thank you to our audience for being with us today. We look forward to seeing you at our next wellness webinar. And please keep in mind that shortly after the webinar today ends, there will be a short evaluation for you to fill out to let us know what you think. And with that, happy and healthy financial wellness to you all. Thank you for your attending.